Hi, and welcome to Wescott's latest webinar series. I am Mark McCarron, Wescott's CIO. And today we're going to talk a little bit about our outlook. And our outlook really based on the questions that we're getting from clients. And this is important because the last couple of weeks we've been focusing on portfolio strategy, how we're positioned, what actions we've taken. But a lot of questions are coming, of course, as to what's next. Essentially, how do we get back to normal? How do we recover from this current lockdown? So we have some questions that we've prepared answers to, and here are the common questions. First and foremost, will the coronavirus-related lockdown lead to recession? And we'll have some thoughts on that. The second most common question is, okay, if that's the case, when will life return to normal? And what will it take to get back to work? And that's an interesting question that we'll dive into as well. And third, how has Wescott prepared portfolios for what comes next? So in each one of these cases, we've got a little bit of an update and some framework as usual. First, a quick update for everyone, the markets through today, April 17th. In the last couple of weeks, we've been looking at market recoveries. We'll talk a little bit about that. And I think the market is beginning to look a little bit beyond the next week or two and really asking the question, if the global lockdown does in fact slow the spread of COVID-19 in the coming months, the expectation is that the global economy may start to recover by late summer. But I think the reality is that even as the country returns to work, aspects of social distancing and periodic quarantines may still be necessary until ultimately a vaccine is found. In the meantime, the decisive policy response that we've seen from Congress and the Federal Reserve, we think will limit, but not eliminate the impact on the economy. But really, most importantly, it's really going to provide a very solid foundation for the eventual recovery. So let's get into that a little bit. We've got some updated information on the economy and how is it faring during this period of time. And the first thing to note is the first question is yes. The answer is yes. The lockdowns, the global lockdowns that the world has been under will absolutely impact global activity and lead to recession. Question is how deep and how long will this last? That's a good question. Right now we have the International Monetary Fund, which provides estimates on global growth, and their estimate for 2020 this year is that global GDP will fall to 3%, minus 3%. And the US GDP will fall to minus 5.9%. That's a far cry from 2.5% to 3% positive growth. That was the expectation as we went into 2020. I think importantly, and the expectation from the International Monetary Fund is that while 2020 will be a negative growth year, 2021 looks positive. In fact, it looks like it's going to be a pretty strong recovery in 2021. Perhaps not as strong as we all would hope, but clearly on the positive side. The second thing to highlight is recent news shows that the retail sales and industrial production, two areas of the economy that drive global growth, they've declined dramatically. So you will see some negative news items and headlines in terms of how consumers are stopping their spending and saving, which I think is very natural during times of uncertainty. And we've also seen that in terms of companies as well, sort of battening down the hatches. That's important, but how long does it last? Well, it will last until there's some semblance of normalcy, and we'll talk through that shortly. The final thing that's on the headlines is the unemployment. There's over 22 million unemployment claims from Americans over the last month. That is dramatic. And we haven't seen anything like this in history. But I think importantly, too, the majority of these claims are temporary, furloughed rather than permanently unemployed. And so when we show this graph, what we're showing here is how the unemployment rate since 2015 has been at 5% and slowly declining, in fact, to a record low of 3.5% roughly at the end of February of this year. But due to the nature of the temporary claims, we will see unemployment rates spike to 10% probably in April and more than 20% perhaps in May. That is dramatic. Again, we haven't seen that in history. But I think we have to put that into context that this is likely to be a temporary scenario. And when things get back to normal or somewhat normal, we expect those employees who lost their jobs temporarily to get back to work. So let's talk about getting back to work. What will it take? And it's really critical that we understand what going back to work means being safe and secure and not putting employees at risk. So what's necessary, I think, is widespread testing for the virus. So today we're all under lockdown, very broadly defined, because we don't know who has the virus and who doesn't. But if there's more testing, and those tests are able to identify those of us who have it and those of us who do not, then we can move from broad lockdowns, which are uncertain and very damaging to the local or global economy, to very narrow lockdowns, which allow many of us to go back to work safely. In positively, we've seen some progress on the development of some of these testing kits, and there's been and there will be increased production of these kits going forward. Clearly, there's been a little bit of a delay in that, but going forward, we're confident and hopeful that the increased production and more testing will allow us to get back to more normal times. However, as we said before, even with more testing, I think some of the aspects of social distancing and some other components of the local and periodic quarantines are likely to remain until a vaccine is found. So what does that mean from an investment perspective? The financial system has to withstand this period of uncertainty. And importantly, too, it's stronger today than it was in 2008 and 2009. And that's because banks have had to have more capital on their balance sheet to prepare for the next recession. The second thing we have to be aware of is the consumer behavior that we're experiencing today may persist going forward. And that may impact certain industries, whether it be travel or leisure activities, whatever it might be. We just need to be thoughtful about how we think about those sectors and industries in portfolios. And finally, we need to focus on companies with the financial strength to make it through the current downturn, because we think they'll be well prepared to thrive in the next environment. So that's what we think going back to work. The market begins to anticipate that, and I think we're already seeing that. So a quick update through the market. This is the S&P 500. This is through data through yesterday, April 16th. But if we just compare what the market's done since the December 2018 timeframe, which is again after a period of a significant market sell-off, there was a very strong recovery and run up until the beginning of this year. This is what we experienced through March, and this is what we experienced since March. In fact, the S&P 500 is up 21%, almost 22% from its low back on March 23rd. So really important to think about the big picture and the long term, because the market is going to anticipate getting back to work before we actually get back to work. So finally, just a review of Wescott's portfolio framework and perspective. Over the last 4 weeks, we've been bringing you a version or a series in our webinar updates in terms of what's going on in portfolios and some of the things that we're doing. Just a reminder that diversification has provided very valuable portfolio protection in these uncertain times. Balanced portfolios did not go down as much as the equity market did in March, and are recovering nicely in April. The market volatility also brings opportunities to add to very strong companies at much more attractive prices. And we did some of that in the midst of the volatility in March. We've also increased the quality in our portfolios, both in the equity and the fixed income, because we think we're still in uncertain times, and that higher quality position will better enable us to add value in the future. And then finally, the maintenance of a long-term outlook is critical. Rebalancing back to target portfolios is critical, and seeking really to take advantage of the opportunities that were presented to themselves in March, really to allow our portfolios to capture the long-term market opportunities going forward. So really that's the framework. We've been able to achieve many of these over the last several weeks. We remain vigilant and focused on managing risk and managing for opportunity. And with that, I just say thank you for joining us, for your continued trust and confidence. And we say this every week, but please don't hesitate to reach out to us, to me, or your advisor if you have any questions. Thank you.